If I'm able to, I will. Right. So welcome to our first session for FAC 3702. Right. We are going to be looking at a very important topic in the syllabus, property, plant, and equipment. So it's a very important topic. It will always be there in the exam and it carries decent marks. Normally in this module, it will probably give you anything from 20 to 30 marks without fail. So we need to make sure that we do a good job on this one and be guaranteed a very good mark on it because we know that it is going to be there in the exam and it carries the highest marks, so we can't miss on this one. Right, so let's look at the topics that are covered in the module besides property, plant, and equipment. Right, so that we can see the work that needs to be done on the module. Right, of course, number one, we've got property, plant, and equipment. Right, very important. Remember, we've said anything from 25 to 30 marks. Right, then we've got investment property. Right, investment property, all the topics are important here, but investment property usually doesn't carry as much marks as, the property, plant, and equipment. Right, and it's not guaranteed that it will be there all the time, but all the topics are important. Right, we then have what we call intangible assets. Right, we have impairment of assets. Right, finally, we have impact of foreign exchange. Right, impact of foreign, right, exchange rates. So there are only 5 topics in the syllabus. Right, so which means usually because it's a few topics, they are able to examine everything in an exam. So we need to make sure that we cover all the sessions, all the topics here that are mentioned in the syllabus. Right, I would like to believe that FAC 3702 is one of the strongest syllabuses in that level. If you do a good job, you must aim for a distinction on this one. Right, let's start on property, plant, and equipment. Right, obviously, property, plant, and equipment is not new to you. Right, you are here because you've done first level and second level accounting, and you did have a look at property, plant, and equipment. So we are basically just adding additional stuff to what you already know or understand from your prior studies. Right, let's look first at the definition of property, plant, and equipment. So basically, when we talk about property, plant, and equipment, these are tangible. Right, these are tangible items. Right, if you want, you can say assets. These are tangible assets. Right, that are held. Right, for use in production. Right, held for use in production or for rental. Right, or administration. Right, property, plant, and equipment. These items are expected to be used for more than 1 year. Right, so these items or these assets are expected to be used for more than 1 year. Right, so basically, if you have assets that are tangible, which means you can touch, you can see them, right? And their purpose is for use in the production of goods and services, right, or for rental purposes or for administration purposes, then we call that property, plant, and equipment, right? Remember, it is a non-current asset, right? It is a non-current asset, which means it is held for more than a year, right? What examples can we give for property, plant, and equipment, good people? Right, what examples can we give from our prior learning? Right, we are very quiet. Right, are we still there?
Yes, we're still here.
Yes.
Wonderful. We can have buildings. We can have motor vehicles. Right, we can have equipment. Right, we can have furniture. Right, we can have fittings. Right, etc. So all these things represent what we call property, plant, and equipment. Right, so the first thing that we want to look at is the recognition of property, plant, and equipment. Right, we want to look at the recognition of property, plant, and equipment. Now, when we talk about recognition, we are saying at what point do we bring an item for the first time into the books of accounting? At what particular point do you say, now we should record this asset in the books? So that is recognition, initial recognition. Right, so on initial recognition, this is what we need to make sure that is there before we recognize. So we're saying an item of property, plant, and equipment, right, will be recognized or shall be recognized, right, if the following are met. So there are a couple of things that must be met before we recognize an asset. Right, number one, it is probably, right, it is probably that future economic benefits, right, that future economic benefits, right, will flow into the entity, that future economic benefits will flow into the entity from the use of the asset. Right. Property, plant, and equipment must have the ability to help the organization generate economic benefits. It must have the ability to help an organization generate economic benefits. So therefore, it must be highly probably, highly likely that an entity will be able to generate those economic benefits in the future. Now, when you say economic benefits here, an asset or an item of property, plant, and equipment should be capable to generate these economic benefits on its own or in combination with other items that are readily available to the entity. Right? If I want to start a school-run business today and I buy a minibus, the minibus on its own will be able to generate economic benefits in the form of, the bus fares that I charge my students. Right? If I buy a computer for a retail organization, the computer on its own will not be able to generate economic benefits. However, the computer is crucial to the sales that we make in our retail shop. So the computer together with other items, other assets, like the computer, the desks, fittings, and everything else will be able to make the company be able to generate economic benefits. So economic benefits are central to the recognition of an item of property, plant, and equipment. Right, number B, the cost of the asset can be measured reliably. right? The cost of the item, which is the asset here, can be measured reliable. Right, so as soon as these two requirements are satisfied, then we should recognize an asset into our books. As soon as we are able to satisfy these two requirements, then we should immediately be able to recognize an item of property, plant, and equipment in our books. Right, so remember, first things first, for us to recognize that asset into the books, it must satisfy the definition of an asset. Right. After satisfying the definition of an asset, it must satisfy, this is called the recognition criteria. So when the definition is satisfied and the recognition criteria is satisfied, at that particular point when all these things line up, then we should record the asset into the books for the first time. Right, then we are saying when we record the asset into the books for the first time, at what value are we going to actually measure or record the asset at? Then we want to look at measurement. Right, we want to look at measurement. Right, basically we're saying when we bring the asset into the books for the first time, what value should we levy on the asset? Right, when we look at measurement, we look at initial measurement. Right, the initial measurement basically captures the value of the item of property, plant, and equipment at the point that we bring it into the books for the first time. Right, so basically, this is basically measurement on recognition. This represents measurement. Right, on initial recognition. Right, measurement on initial recognition. Right, and we are saying the item should be measured at its cost price. Right, should be initially, right, should be initially measured, right, at its cost price. Right, so we need to look at this term cost price of an asset, and we need to understand what makes up the cost price of an asset. So let's look at the cost price of an asset here. Right, good people, from our prior experience in the lower levels, right, what makes up the cost price of an asset? What makes up the cost price of an asset, good people?
Good morning.
Yes, ma'am.
It's the purchase price plus any other costs that were paid in order to get the assets in its location or condition for it to be used by management. That would be the transport cost, the assembly cost, and what else? Yeah, I think the purchase price, the transport cost, any other cost that is yeah, that will be paid in order to get the asset in its location or condition.
Right, wonderful, 100% accurate there. Right, so as she is saying, the cost of an asset would include number A, right, the purchase price of the asset. Right, the purchase price of the assets, right, less taxes claimable from SARS. Right, in particular, VAT, right, so it would be less the taxes claimable from SARS, less any discounts offered, right, and rebates, but including import duties, right, and other taxes not claimable from SARS, right, and other taxes not claimable from SARS. Right, so basically, when you look at the cost price, you must remember it must be the cost price excluding VAT, but inclusive of any other taxes that are claimable, that are not claimable from SARS. If you have been given discount and rebates, it is the price after removing the discounts and the rebates. Right, besides the cost price or the purchase price, it also includes the direct costs, right? The direct costs incurred to bring the asset to intended use and condition. Right, so any direct costs incurred in connection with the asset to bring it to a condition intended for use, right, will be added to the cost price. Right, so when we say direct costs, this is a cost that would have not been incurred by an entity, right, had it not been for the purchase of the asset that we are talking about. So this is a cost that is as a direct result of the acquisition and bringing the asset to intended use. So examples of the costs that we include here, right, we include transport costs, right? So if you are purchasing an asset and you incur transportation cost to bring it to intended use, right, you add that particular amount, right? We have also insurance, but we must be clear while transporting, right, the asset to your premises. Once the asset is on your premises and is ready for use, any insurance will not be capitalized to asset. It will be a normal expenditure. Right, we also have cost of site preparation. Right, cost of site preparation. It is quite possible that you bring in an asset from outside, but the place where you are going to place the asset must be prepared. Maybe you need to put a stand, or you put a stage or something of that sort, and then you place the asset on top. Or you need to change basically one or two things on your premises so that the place is suitable for the asset that you are buying. Right, so those costs of preparing the site should be added to the cost of the asset. We also have employee costs. Right, sometimes you will have employees, for example, maybe that will work on the preparation of the site to make sure the place is ready for the asset, or employees that will work maybe to lift the asset from when it comes through and to place it where it is supposed to be placed. Right, those salaries for those employees for the duration of bringing the asset to intended use, right, you must add. Right, we have installation, right, and assemble costs. Right, at times when you bring an asset, it may not be ready to be used as it is. You need to install it, right? Or it comes in fragmented pieces and you've got to put it together, which is assemble. Maybe you hire experts to come and do that, or you've got the people in-house who are going to do that for you, right? So therefore, if there is an extra cost that was not there already in the entity that you have got to incur in order to install the asset, you have got to add that to the cost. Right, there is the cost of, is it training? Cost of testing. Right, cost of testing. Training is not included here. Right, testing assets. Right, less proceeds. Right, less the proceeds. Right, from sale of produce while testing. Right. So at some point, at other times, when you are introducing an asset, maybe it's a machine, you need to test the machine for functionality. Maybe you do a production run. Right. In that production run, right, maybe you incur electricity costs. Right. There are people who work there, the labor costs. Maybe you consult an expert. You buy the raw materials to be used in your test run. Right. Let's say all these things cost you 10,000 rand. Right. You then produce a number of items, right, that are in good condition for possible sale. So you then sell your produce, right, and receive 4,000, right, from the produce that you produced while you're testing, and you have a market for that, you dispose it. So you then have an amount of 6,000. So this is what you add. This is what you add to the cost of the asset. You have to less any income that you derive from the proceeds of testing, right? From the total cost of that, what particular exercise to test run the machine or whatever asset that it is that you are bringing on board. Right, so we do add the cost of testing after netting off any income derived from the proceeds of the testing. Right, then we also have professional fees. Professional fees, these are consultation fees. Right, if you are building a structure, you will have engineers, you will have architects who will come and help you with the construction process. Right, so all those things you are going to add to them. Now remember, the following are excluded from the cost of the asset, initial cost. Right, the following are excluded. Right, the following are excluded. Right, number one, this is the training of staff. Right, when you bring a new machine, you may want to train staff so that they are proficient on the use of the asset. Right, opening of new facility costs. Right, you have built a wonderful factory. It's a very big mega factory. You invite the president of the country to come and cut the ribbon. There are going to be expenses incurred there. So when you do that ceremony of cutting the ribbon and you incur certain costs, you cannot add them to the cost of the asset. So a cost of opening a new facility should never be added. Right? Administration and general expenses, again, should not be added. Right? Administration and general expenses, these are excluded from the cost of the asset. Right? Then we also have cost of conducting a business in a new location. Right? In a new location. Right, cost of conducting business in a new location. Right, these are not included. So these may include such things as advertising. Right, you have built a new factory. Right, and you have got new products that are coming through and you advertise them. and you are going around looking for people so that you can make them aware that you've got this facility that can service their needs, right? You can't include that cost. It's a normal business expenditure. Don't capitalize that amount. Right, so what we have here, these are what we call the initial measurement costs. You should add them, and we've also highlighted the cost that must never be added. Right, you need to be very clear about this. Remember, property, plant, and equipment is very important, and it will be there in the exam. And one of the things that you will definitely probably come across is the calculation of the cost price. Right, let's look at subsequent measurement. Right, let's look at subsequent measurement. Right, subsequent measurement, we are saying at any other point other than the initial recognition date of the asset. At what value are we going to measure the asset? Now, we must be clear, the value of an asset does not always remain the same, maybe except for land. The value of the asset can change. It can increase in value. It can decrease in value as well. But usually it's a decrease in value as we acknowledge the wear and tear of the asset through usage. So therefore, we need to know how after initial valuation should we measure an asset. The measurement is usually done at the end of each year. So normally this is more pronounced at year end. That's when we remeasure the value of the asset. Right, there are two methods, right, that can be used to measure the asset subsequently. There are two methods for subsequent. Right, there are two methods for subsequent measurement. Right, which are the two methods, good people?
It's the cost model.
Right, so we've got number one, we've got the cost model, or number A, cost model. Right, when we use the cost model, we are saying the asset will then be measured at its carrying amount. Right, asset is measured at its carrying amount. Right, and the calculation of the carrying amount, right, is the original cost of the asset less any accumulated depreciation. So the two important things in order for one to calculate the carrying amount, right, we need to be very clear on the determination of the initial cost of the asset. Then after that, we need to be able to calculate depreciation. I've already mentioned the cost of the asset above, even though we didn't do a question, because this is simple stuff that we would have covered in the prior module, right? But you must be very clear on the calculation of costs. Let's look at accumulated depreciation, or let's look at the term depreciation. Right, depreciation captures the decrease in the value of the assets. Right, the decrease in the value of the assets, right, through wear and tear. Right, so obviously, as you are using the assets, the asset cannot remain of the same quality, of the same age as of when you bought it. As you are using the asset is aging, and therefore its value is going to decline. So the decrease in the value of the asset, we call that depreciation. We have to measure that, and we have to account for depreciation on a yearly basis if we are applying the cost model. Right, so when it comes to depreciation, we have a number of methods that we use. Right, which methods do we normally use, good people?
The straight line method.
Right, we have our usual straight line method. Right, so we have the straight line method. Right, at this level, they are not really going to be, very strict in terms of how you calculate cost, right? Or how you calculate the straight line method. You are assumed to already have this knowledge from the prior module, from 1501, 1601, and 2601. So it's not really that you get a lot of questions on the calculation of the straight line method, but you must have appreciation. So remember, to calculate the straight line, we take the cost of the asset multiplied by the rate, right? Then we are able to get the depreciation, right? Prorated for the number of months in a particular year in which the asset was used for, right? Or we can calculate it by saying the cost of the asset less residual value. Right, then all of this divided by the useful life of the asset, the remaining useful life of the asset, and then we'll be able to get the depreciation amount. Right, so this is the calculation that we have. These two are just part one and the same. Right, for example, if I have an asset, right, bought an asset beginning of the year, right, for an amount of 1 million, right, and then we say residual value is nil, and then we say useful life is 5 years. Right, when I want to calculate my depreciation, of course, I will say, what is the cost price? 1 million. What is the residual value? 0. What is the remaining useful life? Right, the remaining useful life, or the initial useful life of the asset, is 5 years. Right, so which means we are going to get how much? If we divide there, we're going to get 200,000. So therefore, we get 200,000, which is depreciation per annum. Right, so this will be the depreciation. Right, so we maybe make a shortcut out of this. Instead of always doing this calculation, we can just do a shortcut and then say, how does it translate to a rate? It's simple: 200,000 divided by the depreciable amount, which is the 1 million. So therefore, that will give us a depreciation rate of 20%. So that therefore, if we are now using that method, we now simply say on a yearly basis that multiplied by 20%, and we get the 200,000. So the percentage is actually derived from this calculation. It's just a shortcut. But remember, you must divide by the depreciable amount, which would be the amount after you have deducted your residual value, if you have residual value in your question. So then you are able to get the percentage. Now, this method of depreciation, we must be very clear from the onset, it gives the same amount of depreciation from one year to the other. It doesn't change. That is why we can rely on a percentage, 20%. Right, we have another method, which is the residual value method. Right, also known as the diminishing value method. What is our formula here, good people? Right, what is our formula? Right, the formula for this one is very simple. Right, it is your carrying amount for a particular period. Right, carrying amount at the beginning of the year multiplied by the rate. Right, using the same example as above. Right, in year number one, right, my depreciation will be calculated as saying, right, the 1 million, which is the original cost, less any accumulated depreciation. The asset was bought at the beginning of year number one. There was yet no depreciation at that particular point. So therefore, depreciation will be zero multiplied. We have already determined that, let's say the rate is 20%, right? So assuming, right, and then we are assuming a rate of 20%. So my depreciation will be 200,000 a year. Then we go to year number two. We now say 1 million less the accumulated depreciation, which is the total depreciation up to a particular point, multiplied by 20%. Then we get our VAR. So it will be 800,000 multiplied by 0.2, which gives 160,000. Right, then we can add here and see that we've got total accumulated of 200, right, plus 160,000, which means at the end of year number two, our total accumulated depreciation is that. Then we go to year number three, right? So we say 1 million less the new accumulated depreciation, which gives us the carrying amount at the beginning of the year, number three multiplied by 20. So therefore, we're saying 1 million minus 360,000 times 0.2, and that is going to give us 128,000. So this is how we apply the reducing balance method. So hopefully we are all on the same page. I'm just running through this. It's already assumed knowledge in this module. Any questions, good people, on the residual value maybe? Right, are we clear? Right, let's go to the other method number three that we sometimes use here, right, which is, what is it called, by the way? Who remembers?
Sum of units produced.
Right, sum of units produced method.
Yes.
Right, thank you very much. Sum of units produced. Right, this is the easiest of all these particular methods. Right, this method is going to be based on an initial estimation of the total number of units that your asset is going to produce, or total output of your asset. Right, so let's see, I'll give an example here. Right, let's say you bought a machine. Right, you bought a machine, right, beginning of the year. Right, let's say your cost price is equals to 1 million. Right, and then this machine is expected to give us an output in total, right, of 100,000 units, right, in year one. Right, let's say 20,000 units were produced. So your depreciation here will therefore be 20,000 units produced over the total of 100,000 units multiplied by the value of the asset. And the answer will be your depreciation, which is 200,000. So in each particular year, you just determine how many units you produced over the total, right, multiplied by the 1 million, which is the cost of the asset, and then you get your depreciation. So it's a very, very straightforward method of depreciation that can be applied. Right, I want to look at also the other method, or before I go to the other method, which is revaluation, right, I want to look at, all right, let's go to revaluation. Let's go to revaluation. So remember, we are saying there are two methods that we can use for subsequent measurement of an asset, which is the cost model, as well as the revaluation model. Right, so the revaluation model, right, is applicable to non-depreciable asset. Right, so we won't be applying this method to assets that have depreciation. Right, and then this method we are saying value or measurement of the asset. Right, measurement of the asset is determined, right, by the revaluation amount. Right, this is based, okay, I forgot amount there. Right, this is based on the revaluation amount. Right, and the revaluation amount is based on the net realizable value of the asset. Right, in other words, the net realizable value of the asset is determined basically by the market for the asset. So what you then do, if you have an asset, for example, you've got land which you don't depreciate, you bought it for 1 million, right? And this is 5 years down the line. If you have never revalued it, it will be in the books at what? 1 million, because we don't depreciate that. Right. However, we're saying the price for land fluctuates in the market, and there is a possibility that the current price that you have in your books is no longer in line with market values for the asset. So you will then go to the market and look for a similar asset, similar size, similar location, and determine the market price there, right? Less any cost to sell the asset. So that will be your revaluation amount. Right. If the revaluation amount is now higher in the market, maybe it's now 1.5 million, right? But in your books, your asset is still recorded at what? 1 million. It means your asset is now undervalued. Then what you can do is you can add the 500,000 on top of your asset. And that revaluation amount that you're adding will then take the value of the asset to a more realistic value in the market. So that is called revaluation. Right. If the asset's value has decreased in value, you can decrease the asset to its net realizable value. We call that impairment. Right. Are we clear, good people? Right.
Yes.
So what we are saying, if a net realizable value is higher, right, you add the extra amount, right, which we call a revaluation surplus. Right, the revaluation surplus that you would have added, right, is accounted for as follows. Right, so in the P&L, remember this represents a gain. Right, so it will go to the P&L account. It's part of other comprehensive income. It will be part of other comprehensive income. So it doesn't go to other income here. Then in the statement of financial position, right, under what we call equity, right, the revaluation goes or is added to other reserves. So it will form part and parcel of what we call the reserves. So this is how we deal with the revaluation surplus. Now remember, if your asset is now overvalued, maybe the market has crashed for the asset, you bought it for 1 million, but in the market, the asset is now worth 700, right? The decrease in value would be a loss by the entities called impairment of the asset. We will deal with impairment later in the module. There is a topic specifically for impairment. Right, so we are saying when it comes to the measurement of the asset, we are either using the cost model or we use the revaluation model. Any question up to where we are, good people? Are we clear?
Yes.
Let's
Yes.
go to the next thing. Now, remember, we mentioned the initial cost of an asset, right? To say when we bring an asset into the books for the first time, right, there are costs that are incurred. We then indicated the ones that we capitalize. Now, the question is what happens to subsequent costs in connection with an asset? Because there is a possibility that we may have subsequent costs that are then incurred with regard to an asset. So we need to be able to account for that as well. Right, what do we do concerning subsequent cost, good people? Right, these are costs associated with an asset that may subsequently be incurred by an entity. Right, we need to also know how to deal with those. Right, how do we account for those, good people?
I'm just gonna give it a try. Do we not capitalize them against the carrying amount of the asset?
All right, it depends.
Mm.
Right, let's go to subsequent cost here. Right, let's have subsequent costs. Right, so let's maybe just explain what this is. These are costs, right, associated with an asset,
Mm.
right, and incurred after initial recognition.
Okay.
Right, we know what to do with the initial cost. We capitalize them if they are direct costs, and we have a list there. But these ones we haven't discussed yet. Let's go through these ones. So these are costs
Okay.
associated with an asset and incurred after initial recognition. Right, these costs could be right. Number A, repairs and maintenance. Right, so if these costs are repairs and maintenance, we don't capitalize them.
Yes.
Now, repairs and maintenance simple means that we are restoring the asset back to its normal condition. Ne? So, for example,
Yes.
if you've got a building and someone breaks the windows and you repair them, you can't capitalize that because it doesn't increase the value of the asset.
Mm.
This will expense to the P&L. Right, do not capitalize. So this is one type of expenditure that you can incur subsequently. Right, then you can have maybe a capital expenditure. Right, what we call additions. Right, these you capitalize. Right, these are additions. Let's say you have got a building, it doesn't have maybe it's a hotel, you are running a hotel business, but it doesn't have a swimming pool. You decide to put a swimming pool. So now you are extending the property and you are increasing its value in a way. So that you are going to capitalize to the value of the asset. Right. Let's say you have got a building, right? If in that particular building, then you put in movable furniture. You put couches. You've got a building that you use for admin, and you put a movable there. You don't capitalize that to the building. Right?
Yes.
But if you place fitted cupboards on that particular property, it increases value. So it's an addition
Mm,
to the property you must capitalize. Now that we have
yes.
a thing called capitalization, let's also explain how we deal with depreciation here. Ne? Right, let's say, I'll give you an example. Right, let's say we have a property, right, and this property is a hotel. So bought a hotel, right, beginning of the year, right, for a value of 1 million. Right, depreciation, 20% per annum straight line. Right, then they say in year 2, right, added a swimming pool. Right, they say the swimming pool was 200,000 and it was put at the beginning of the year. Now remember, the swimming pool is not a new asset. It is an addition to the building that we already have. It's an addition to that hotel. Right, so what will happen is this. When we calculate depreciation, or we calculate the carrying amount of the asset, right, in year number 2. Right, in year number 2, remember, we now have the cost of the asset as follows. All right, so I'll give you, I will say a carrying amount, right, beginning of the year. Right, remember, initially the asset had cost us 1 million. Right, and then we accumulated depreciation at the end of year number 1, which is 1 million, multiplied by 20%. This is year number 1, which is 200,000. Right, so which means at the end of that year, we were sitting on a value of 800,000, right, being our carrying amount at the beginning of year 2. Ne? Then we now go to additions. This particular asset, we added a swimming pool with a value of 200,000 to it. Then let's calculate depreciation. Right, when we calculate depreciation, remember, they cannot be a swimming pool without the hotel. When we depreciate an asset, remember we depreciate it to 0. So what happens now with the standard at this level is you cannot continue to have a swimming pool when you have fully depreciated the what? The building, the hotel. So the assets, which is the hotel, including the swimming pool, must reach its 0 value in terms of book value at the same time. So therefore, you are going to say when you calculate depreciation, right, 1 million for the original asset value times 20%. Then you are going to say for the building 200,000 times 20% times 2. Right, so that after the end of the year, the remaining useful life of the swimming pool is the same as the remaining useful life of the asset. Are we clear about that, good people?
Yes.
Right, so you are going to have 280,000 here. Then you can close and calculate carrying amount end of the year. So this is when you have an addition to the property. So the cost now becomes the original value, 1 million, right, plus the 2,200,000, giving us a 1.2 here. Right, then accumulated depreciation this time will be the 200,000 beginning of the year plus the 280 in the current year. Then we have 480,000. So that therefore we now have this value 1.2 minus 480, which gives us 720. So the idea is to make sure that the remaining useful life of both assets is equalized and becomes the same, so that you don't have a swimming pool as a standalone after you have finished with the what? Depreciation of the hotel. Are we clear?
Yes, yes, we're clear.
Right. So we have the repairs and maintenance, we expense that. Capital expenditure additions, we capitalize. But we have a special case also for what we call a significant. Is it significant? What's the term that I'm looking for?
The significant parts.
Parts, is it significant parts or?
I think so. Let me just check.
Right, I want the correct wording there.
If I can find it.
In costs, ne? Right, I'm looking at significant cost. Right, just the wording. I know it's there in the study guide somewhere. Right, let's say, right, significant or major components, that's the word. Right, major components, right, significant, servicing, right, major components and parts.
Oh, it says here major inspections. I'm not sure whether it's the same.
Right, it says major inspection component. That's what I'm looking for.
Yes.
Major inspection component. Right, so these three terms will work just fine. Right, so when you look at significant servicing and major inspection, these are what ordinarily would have been repairs and maintenance, ne? Right, if they were not said to be major. These are what would have been classified as repairs and maintenance. Then we have components. Components are also for repairs and maintenance. If you have got a motor vehicle and you replace a part with another, that's a repair. But when we describe these as major or significant or major inspection components, right, these we capitalize. Right, these are capitalized. Right, examples here. Right, let's say you have got a plane, but this plane you need to replace seats, say every 5 years. But the useful life of the plane is 30 years. Right? Or in your standard, they'll give you an example of a placed furnace. If you have a placed furnace, the lining of the walls of the placed furnace must be replaced regularly. So that's a major inspection component. Here, the seats will be a major inspection component. Or you have got an asset with major parts, like the engine of a vehicle, for example. It's a major component in that particular vehicle. So let's say you have got a specialized vehicle that you are using as a shuttle. right? You want to make sure the asset is always in tip-top condition. So what you do, the engine you replace every 2 years. You replace the engine, you buy a new engine, you place a new engine there. So that's a major what? A replacement of a component there. Now back to the example of the plane. Right, the plane itself has got a useful life of 30 years. But this is a luxury plane. You want to make sure that it's in tip-top condition. So therefore, the seats of the plane, because they get worn out much earlier than 30 years, right? These you replace every 5 years. You need to replace the seats. So what happens now is that the replacement of the seats, which ordinarily could have been described as repairs and maintenance, if it's a significant major replacement of the seat, then you need to capitalize that. It's not your normal repairs and maintenance. Right. So what will happen now is that you need to look at the cost price of the plane. Right. So if the cost price of the plane is 1 million, you need to determine the cost of the seats. Right. If the cost of the seat is 100,000, right, which is included there, it simply means that this will be depreciated, right, over 30 years. But the seats now will be depreciated over 5 years. So you need to separate that cost of 1 million. Right, 900,000, you allocate it to the plane without the seats. Then the 100,000 you now isolate for the seats. When you calculate the amount of depreciation, you must now calculate that separately. Right, the plane on its own over 30 years and the seats over what? 5 years. So that is what we need to do with major replacement component. Are you understanding it? Right, let's do an example, a proper example on that. Right, let's say an entity buys, right, a machine, right, for 20 million. Right, then let's say the machine has a significant component, right, costing 2 million. Right, price included on the 20 million. Right, then let's say this component should be replaced every 2 years. Right, every 2 years we should replace the component. Right, then purchase date 1 January of the year 2024. Right, how do we account for depreciation? So let's calculate depreciation in 2024. Right, when we want to calculate depreciation, what we do is we are going to have a structure like this for the calculation of depreciation. Right, so we're going to need 3 columns here. Right, so we separate now the machine, the component, and we have our total. Right, then we are going to say, what is the cost? Remember, the total cost here was 20 million. Right, however, the component price is included on that fee and it's 2 million, which means the machine without the component will therefore be what? 18,000. Then we calculate depreciation. Right, our depreciation is going to be easy to calculate. For the machine, right, remember, and then the useful life of the machine. Did I give the useful life? I did not put the useful life there. Right, useful life of the machine is 10 years. Right, so for the machine, we depreciate it over its useful life straight line method of 10 years, which gives 1.8 million. So that will be the amount of depreciation that we recognize. Right, for the component, however, remember the component can only be used for a maximum of 2 years. So therefore we say 2 million, right, divided by 2 years, because every 2 years we must replace. So therefore this depreciates much faster at 1 million. Right, so that our depreciation therefore is 2.8 billion, right, at the end of year number 1. Then we can calculate our carrying amount. Are we following, people?
Yes.
Yes.
Right, once we have that, then we're going to be left with 16.2. Right, and then we're going to be left with 1 million there. We are going to be left with 18. But it can't be 18. How can it be 18 there? So I said 20, I think it's 18 minus 1800, like 16.2. That is 17, sorry, my mistake is here. Right. So we have 17,200, right, which is the carrying amount of the assets. Right, let's go to year 2025. Right, now we have scenario number 1. Right, under scenario number 1, let's say that the component was replaced as planned at the end of year 2. Right, for 2.5 million. Right, remember initially when we bought the asset in the first year, it was 2 million. Now the component price has increased. It's now going for 2.5 million at the end of year number 2. Right, how do we calculate our depreciation here? Right, so to calculate the depreciation in this instance, we'll have 2 columns again, or sorry, 3 columns. We are going to have 3 columns. Right, let's have 3 columns here. Right, let's have 3 columns. Right, so this time we're going to have, remember we still have the same, the machine, right, the component, right, and our total. So we now have the carrying amount beginning of the year. Right, this is beginning of year number 2. Right, we had 16.2 there. Right, we had 1 million there. Right, we had 17.2. Right, then we have our depreciation. Right, but before we go to depreciation, we have addition. Right, on the addition here, right, we then say Remember, we are bringing in a new component which is going to cost 2.5 here. So that's an addition. This is being brought at the end of the year. So by the end of the year, this will not have been depreciated at all. It's just an addition. Then we have derecognition. Right, but before we go to derecognition, maybe let's go to depreciation first. Right, to calculate the depreciation, right, for the machine, nothing changes. Remember, it's the straight line method, 18 million. We still divide by 10, we get 1.8. So that calculation would still be the same. Right, are we clear, good people?
Yes.
Right, then we go to the component. Now remember the component up to the end of the year, we're still having the old component, bought for 2 million, right, being depreciated by that. So it gives us 1 million. Nothing has changed, which means we're having 2.8 again here. Right, then what we do, we need to calculate the value. All right, this addition, let me put it down there so that it makes more sense. Either way is the same, the answer will still be correct because we normally put additions at the top, isn't it? But to make sense, I'll just do like this. So what we need to do, we need to calculate the remaining useful life of the asset on the day that the component is what? Replaced. So the remaining useful life here was what? 0, né? Because this would have been depreciated up to 0 there. Right. Normally, if you have a value that is remaining here, you will have to derecognize it from the book. So we don't have anything to derecognize because the asset is no longer there with a book value in our records. Then we bring in the addition. Right, the addition, which is the 2.5, which we bring there. Right, then we can close. The addition is not going to be depreciated in the current year because it was brought in at the end of the year. Right, you calculate your figures there. Right, so this is how you deal with the depreciation of the asset if we follow the replacement plan as it were. Let's go to scenario number 2. Right, let's say replacement, right, occurred in 18 months' time. Now, we had been primed to do the replacement in 2 years, which is 24 months. But it can happen that maybe the component malfunctioned at some point before the 2-year period, and we had to replace it earlier, right? The replacement is still the same, 2.5 million. So how do we account for that if there is a happening of that nature? Right, so what we are going to do is a similar calculation again, but this time there's going to be a small twist. So we still have our 3 columns. Right, so we have the machine, we have the component, we have the total. Right, we have our carrying amount. Remember, we had 16.2 at the end of year number 1. We had 1 million at the end of year number 2. So we had 17.2. Right, then we come here, we say depreciation. Nothing changes for the machine, 1.8 million. Right, but for the component now, there is going to be a change. We replaced the asset before the conclusion of the 2-year period as per our plan. So we say 2 million divided by 10, but we have to multiply by the number of months that the asset was used for in the current year. Right, so if we replaced in 18 months, it means that in the current year, the component was only used for 6 months, isn't it? Right, so therefore, we're going to depreciate only for 12 months in the current year, which is going to give us 500,000. Good people, are we on the same page on that?
Yes.
Right, so therefore, the depreciation amount is going to be simple 500 for this asset. Right, so that we then say 1.8 by 5 plus 500, we're going to get 2.3 instead. Now, what it means at the point of the replacement, this asset still had a remaining value, which is 500,000. However, this value is now useless. Remember, this value is a book value. But let's say the component that we want to replace had malfunctioned and we had to throw it away. So therefore, the 500,000 now should be scraped from the books. So we call that derecognition. Right, this is derecognition. And we derecognize that value of 500,000 here, right? And it's going to be removed also from the total, right? So that the value now goes to 0. Then we have an addition now of the new component, right? The new component was brought in 6 months before the end of the year. So therefore, it will attract depreciation. The plan is still to replace after the year. So we say divided by 2, but in the current year, it would have been used for only what? 6 months.
6 months.
So we say 2500 divided by 2, divided by 2, and then we're going to have 625,000 here. So this is the value that we have. So therefore, we have an additional amount of depreciation here. So again, this is depreciation, all in the current year. And then we can close and we have our figure. So remember, this is not the PP note. This is calculation again, isn't it? You are still going to progress from here and compile the PPE note if they wanted that. Right, so we then have a figure of 14. Right, so this is the amount that we are going to have, 14,400. Right, here we now have 2.5 minus 625,000. So it's 2.5 minus 625, which is now giving us 1,875,000. Right, this is million. Right, which means here we're now going to have 16,275,000. Right, so this is how we calculate the depreciation. Right, if you see students saying that the paper was difficult on PPE, normally it will be because of the inspection component. You need to master this. It's a banana skin probably in the exam there. So you need to be 100% sure of how to deal with that. Right, so let's end it right here for today. It was just an introduction, just a couple of the basics, laying the foundation for our class next week. We continue from here. So next week when we meet, I want us to go through a question. I will share it with you in the group so that maybe you can attempt it. Right, so this one would want you to calculate the property, plant, and equipment as well as the deferred tax amount. So looking at two things, PPE note, as well as the deferred tax amount. So you must know your income tax here to be able to conclude this. Right, it's a very simple calculation. It's free 12 marks actually if you know what you are doing, not a challenge at all. So this is the question that we are going to do next week. And after that, we'll then move in the next session to investment property. It's a very short syllabus. We finish it very fast. Within a month and a half, we'll be done. Then from there, we just do papers until we write. So, but what you do as a serious student, don't come back next week without understanding anything that we've done. I'll share the recording, go through the recording, make sure that when we continue next week and introduce the deferred tax, you are not scrambling for property, plant, and equipment. you already have a good understanding there. And then we finish off the understanding next week because we are going to do the PPE note. But then we add now the effect taxation. Right. Thank you very much. My recording, you will get it latest on Monday. Otherwise, if time permits, I'll send it tonight. Thank you.
No problem. Thank you so much.
Yeah.
Just a quick one. I
Yes.
saw the PDF that you sent on WhatsApp. It has semester plans, like the cost that you must pay.